So I think it changed minimal. I think a lot of this is entrenched. A lot of this is demographics. A lot of the Social Security, the Medicare stuff is demographics. The very high healthcare spending has been an ongoing problem. Both private sector and public sector spending in the U.S. is our healthcare per capita is the highest in the world without really good outcomes to show for it. Defense is all sorts of geopolitical issues, but also tons of fat that they could cut out, but is very entrenched. I think that like the main moving parts there are if we had gotten a Harris victory, then we would have had to more seriously consider some of those Trump era tax cuts expiring, going back into effect, which would have been effectively a tax increase. Now, because we get the Trump victory, those are less likely to be allowed to go back in. They're more likely to be either extended or made permanent in some fashion. And so that's basically all else being equal, a deficit contributor. But then on the other hand, now we have to seriously consider tariffs to some degree. And those are tricky because to what extent are they taxes on the American people versus taxes on foreign businesses? The proponents of tariffs would like to say that it's going to come out of the profit margins of the foreign producer. But a lot of, especially physical goods, a lot of profit margins are 10, 20, 30%. So if you put 20% tariffs on someone, they're either going to not sell to that market or they're probably going to increase prices to some degree. And so we could see additional revenue from I believe they call it the external revenue service. So that could balance it out. I still think tariffs are one of the biggest things to watch because we don't know the magnitude yet. We've seen kind of the opening statements, kind of what the initial side of the negotiation. But where do those actually land in practice really remains to be seen. I generally would take the under, just because I think it's an administration that'll be very careful of market disruptions that are abrupt, but we'll see. And in general, there's a lot of emphasis put on how many workers are in the federal government. There's always like programs you can point to that are incredibly wasteful, $1 billion to save this like rare type of trout in someplace. Like there's always things like that, and you can get a lot of optical victory by like trimming some of those. But the major areas of spending are Social Security, Medicare, interest expense, DoD, veterans benefits, and that type of stuff. And the GOP had it in their 2024 platform. I believe it was Promise 14 to not cut Medicare or Social Security or raise the retirement age. So this is not the Paul Ryan era of the Republican Party. This is a little bit more of like kind of socially conservative, but fiscally more moderate kind of Republican Party that we see, because that's a very strong voter base is people that receive those benefits. So a lot of that is locked in very, very kind of the third rail to go after. Interest expense is obviously very hard to go after. DoD is a potentially big area to cut. But every one of those programs is going to have whatever congressperson has that in their district fighting for it. And so that's, I think that they could get some optical wins there, but we're talking tens or potentially 100 billion in a deficit that's, bordering on 2 trillion. So I think in terms of big numbers, my deficit view is largely unchanged, but I continue to monitor any sort of legislation that pops up. I mean, there's Fed independence to some degree, right? So that's a Fed decision, not a fiscal decision. And generally speaking, if the fiscal authority has direct control of the Fed, that's usually not a monetary situation you want to see. But if they were to do it, if the Fed were to decide to do it, there'd be a couple things. One is you probably would have a substantially weaker dollar, and therefore you'd probably have substantially higher energy prices. So you'd probably get a burst of inflation from that. But then you would notably cut the deficit. You would, cut the interest expense over time. It would take a while to play out because some of that is locked in for several months or a few years. But that would start to rotate back down. We probably would see, it's unclear what would happen on the long end. If the market was spooked by it, that, we might not see that translate into, more bank lending. And you could end up with a situation like Japan. I mean, part of why Japan, they had some of the slowest, everybody talks about Japan as like a money printer, but they actually had like the slowest money supply growth from the year 2000 to the present among major currency blocks. And there's a couple reasons for that. Like, their central bank balance sheet went vertical, but their broad money supply was actually very slow growing. And there's a couple reasons. One, there was private sector debt reduction, which when you pay off a loan, you destroy broad money, and that was offset by monetized fiscal deficits. So basically, if you're doing 5% a year monetized fiscal deficits, and then you're reducing corporate and private debt by 2% a year, you're left with like 3% net growth, which is low. And so that's kind of the situation Japan went through. It's harder in the U.S. because we're running structural trade deficits. So our currency, could have more issue with kind of perpetually zero rates when other major currency blocks are not at zero. The funny thing is it would then probably allow other big currency blocks to cut their interest rates, maybe not to zero, but they could lower them a lot because their biggest benchmark comparison is now eased. And therefore you could get, for example, a boom among the BRICS countries. Like right now, Brazil is running fiscally hot like the US, but they don't have the world reserve currency, so they're actually pressured by it. And their central bank is keeping rates really high to kind of keep a lid on that. But if the dollar was cut to zero, the Brazilian central bank could probably ease, and that'd probably give a little bit of a boom in Brazil, which would then compete for things like oil and commodities and probably give us some inflationary pressures. So the part where I would agree with him is that interest rates are not the strongest lever to control inflation when you have fiscal dominance, because you raising rates does slow down bank lending a little bit, but it also blows out the fiscal deficit by literally a bigger number. And so it's kind of a mixed bag. And so I'm kind of neutral on that whole thing. The biggest levers for in inflation and this whole thing is energy abundant, is trade flowing well, are there any clear bottlenecks that can be addressed, and then what is the overall size of the fiscal deficit? And so I think there is merit to that. I think if when you look at a country that's even further in fiscal dominance, like Japan, you can get to an argument where interest rate increases are actually pro-inflationary directly, but because the U.S. is kind of teetering on fiscal dominance, interest rate increases probably have a somewhat neutral effect, which is to say that you do slow down bank lending and you do increase the fiscal deficit by roughly similar amounts. Whereas in Japan, bank lending is super sluggish and debt to GDP is even higher. So every 100 basis point interest rate increase would have an even bigger ratio of deficit increase versus bank lending slowdown. We see China being really sluggish on energy. We see some other BRICS like Brazil trying to really control their inflation, and so they're kind of somewhat keeping a lid on it as well. I think it's a noble goal to want to increase the U.S.'s output by 3 million barrels. I think it'll be challenging. And the reason for that is I think most of the current kind of like stagnation in U.S. oil output is more a matter of corporate decisions and then also well depletion rates, more so than just the Biden administration. So the Biden administration was actually more bark than bite on energy. So they had a lot of initially campaign targeting against hydrocarbons, but then when inflation hit, they were, their actions were actually not very aggressively against drilling. It was kind of it goes back to optics. A lot of it was optics rather than, like a company actually is going to want to do something and then they get blocked from it. Instead, back in the 2010s when the U.S. shale oil supply was ramping up, a lot of that was unprofitable drilling. And there was a lot of external investment in oil and gas producers. And a lot of them blew up because of that. Whereas the current time, we don't see a lot of external investment in oil and gas. And oil and gas companies are mostly drilling from their own profits. So every time they make a dollar, they decide, okay, do we want to pay dividends? Do we want to buy back shares? Do we want to pay off debt? Or do we want to invest this back into the ground? And because, OPEC has spare capacity and China demand is sluggish, they've not been super aggressive at wanting to put it back into the ground. And then shale has higher and higher kind of depletion rates year after year. And so it's kind of like the Red Queen syndrome, trying to maintain the current output, let alone increase it by another 3 million. I certainly think they could increase it. Three is a pretty aggressive goal. Now, if you do really aggressive like tax incentives or something, like if you really push it hard, it's possible. But merely, enabling more drilling and giving the industry more of like a 4-year green light on drilling and things like that, that alone is probably insufficient to get you 3 million barrels. I don't really see acute energy shortages on the horizon currently. But I do see just kind of gradually tightening, increasing. So if China decides to stimulate a little bit more, and as we see just ongoing well depletions, I think the industry is pretty much in balance. Could be erring toward tightness. And one of the interesting factors is if we do start increasing our export capacity, our natural gas prices could increase. So right now, oil is pretty fungible. It's relatively low cost to transport it around. Whereas natural gas has a lot of limits for transporting it, given you either need a pipeline or you need expensive LNG export facilities and pipelines to bring it to them. And as we increase our export potential, we could see a normalization where North American gas prices go up and then bring down gas prices to the places that we are exporting it to, which currently have much higher prices, which can't really be arbitraged because of that limited throughput in terms of exporting. So I don't really see energy-driven inflation as a key risk the next, call it 2 years, unless there's some sort of major kinetic warfare thing that kind of brings oil offline. But it's something certainly worth watching. Well, I think gold's been benefiting the past few years because Bitcoin's too small. And so when these countries want to, around the margins, de-dollarize at the sovereign level, gold is their obvious choice for savings that they don't need to be very fast, right? So they can hold them long term. The bigger Bitcoin gets, the more it starts to compete with gold potentially. Around the margins, I think it's already competed with gold a little bit, but actually I see more indications that it's competed with silver, platinum, and gold miners. Because if you're a hard money enthusiast and you have a bunch of options for things you could previously invest in, it'd be gold, silver, platinum, the miners. Generally, if you want low volatility, you go with gold, and if you're more bullish, you want that higher volatility. If you're more of a trader mentality or just want that kind of you're more bullish, you go with the higher vol things. But now with Bitcoin, it's higher volatility without the operational risks of being a gold miner or things like that. So I think that actually some of those higher vol hard money assets have been more directly impacted by the existence and growth of Bitcoin and to some extent the broader crypto space. If you start to get bigger and bigger with Bitcoin, then potentially starts to challenge gold more directly. Probably not for quite a while. And then even in that scenario, kind of like how gold is always like seen as like the hedge against some sort of major economic issue, you could see gold as like the hedge against some sort of major cyber attack or something. People, there'll still be entities around the world that say we want to have some analog wealth stored rather than, put every single thing on this network. So that it certainly still could be seen as like a backup option and just a different type of backup. So I still think that compared to the global bond market, gold can still grow into that, even as Bitcoin is on its flank, kind of growing into gold to some extent.